Hi, I'm Mal from the Money Study, bringing you another episode in You and Your Superannuation. This is episode number 3, and we're talking about the other type of contribution. This is the concessional contributions. This is where we can get tax deductions for putting money into super. Before we give the details, there's my disclaimer, all about facts and figures, information only. This is not advice. Okay. In the previous session, we talked about non-concessional contributions, where we can just take money out of a bank account and plonk it into our super fund, and whatever leaves the account arrives into the other account. These are the other types of contributions, and this is where effectively the ones we think of mainly coming from our employer. So as our employer puts money into a super fund, yep, that is a concessional contribution. If you decide to do salary sacrifice, and we'll be doing a session on salary sacrifice very, very soon, then this indeed is still an employer contribution, because what you are doing, you're saying to your employer, please drop my gross income. Instead of giving me the income, can you put some of my wages into super before I get taxed? And hence the actual contribution for salary sacrifice is coming from the employer. So it's actually classified effectively as an employer contribution. Of course, a non-concessional contribution, the ones we've been talked about in the previous sessions, they can be converted into a concessional contribution by literally filling out a form to claim a tax deduction. And I'll show you how this form works in very shortly. But so we can put the money in as a non-concessional, but it can indeed be converted. So why do we want to convert it? Because with concessional contribution, the pure word of concessional means there's a benefit here, and the benefit is we get a tax deduction for putting the money in. But, and this is the big but, as we receive a concessional contribution, it always gets hit with a 15% contributions tax. So as it goes in, 15% of the contribution is lost in taxation. And you go, well, hang about, why would that concessional be better than a non-concessional? Because there's no taxes that goes in with non-concessional. Now you're telling me that I'm going to lose 15% if I do it this way through my employer. The reason being is that, yes, you lose 15% of it as it goes in, but depending on who put it in there, whether you or your employer put it in there, either we're going to claim a tax deduction to get the tax deduction back at tax time, or if your employer is putting it in for you as salary sacrifice, we get the tax deduction every week by a reduction in our overall tax from our pay packet. So we're getting a tax deduction for putting this money in. So you can obviously understand that depending on what tax you pay, the higher your tax bracket effectively, the better the benefit's going to be. So if you're earning, let's say 70,000, you are in that 32.5 cents in the dollar tax bracket. You lose 15 as a contributions tax, but you get a tax deduction at 32.5, then you actually make the difference effectively 17.5% of the contribution. If you're earning over 120, you're into the 37 cents a dollar tax bracket. You lose 15 to make 22, and so it goes on. So obviously down the bottom end, it's not quite so beneficial. If you're only earning 35 and you're in that situation where you are only paying tax at 19 cents in the dollar, then the benefit isn't the same. So it's a case of understanding how it actually impacts on you, because the benefit of a concessional contribution could vary quite dramatically between you and your friend, literally because of your total income there. Now, of course, you can understand someone who is not even paying any tax. So let's imagine someone's only earning $16,000 a year or something on a part-time job. Their income's underneath $18,200. They don't pay any tax. And then, of course, if their employer puts money in and you lose 15% of the contribution in a contributions tax, you sort of effectively saying, well, superannuation is a waste of time for me. But luckily the government has sort of thought about this issue, and effectively anyone who earns up to $37,000 a year, then you may indeed be eligible to receive what's called this low income super tax offset, or LISTO as they call it, which is a payment of $500, which basically what it's trying to do there, it's replacing what you are losing in the 15% tax. So you lose it in one hand, but then the government gives it back to you effectively as this super tax offset. You don't need to do anything. There's no sort of paperwork or such to fill out. So long as your super fund's got your tax file number, this will effectively occur pretty automatically from that point of view. So so it's not too bad for the low end, but certainly not as beneficial, obviously, as someone on a bigger income making some reasonably good tax benefits by putting money into super. But of course, with everything that's beneficial to us, the government puts a bit of a clamp on it. They're trying to encourage us to put money into super by giving us the tax advantages, but then they slap us over the head and say, look, yeah, well, you can't do too much. We don't want you to get too much of a tax benefit, otherwise we're going to lose taxes this financial year. I think it's a little bit sort of narrow-minded or short-sightedness of the government in a way, in the regard that if they really want people, especially the baby boomers that are trying to play catch-up here, to restrict in what they can put in or encourage them to put money in and stop encouraging them to put in, because they miss out on a bit of tax now, but then of course if the baby boomers don't get enough in, they'll be putting their hand out for settling. So it's a bit of a which way do the government really want to play this game? But anyway, there's a cap, and the annual cap for concessional contributions is $27,500. $27,500. Now, that $27,500 is a total concessional contribution cap. So if your employer is putting money in and you want to make additional concessional contributions, you've got to take those employer contributions into account. So if your employer was putting in $10,000 worth of contributions, you can only do an additional $17,500. For anyone who's listening who is in the PSS or CSS or one of these defined benefit schemes, please go to our PSS defined benefit Facebook page or YouTube channel, because yours is different on what you have to subtract. There's a notional value you need to subtract. But this session is just for people in general normal super funds, and hence your restriction is $27,500 minus whatever the employer puts in. Now this cap will indeed go up, grows with a thing called a WOTI, the average weekly ordinary times earnings, an indexation on salary effectively, and it'll go up in $2,500 steps. So with wages now starting to move, it would probably and most likely that this cap will go to the next step at $30,000 probably by the 1st of July this year, 2024. So if it goes up to another $2,500, that means you can literally contribute a further $2,500. If your salary goes up, of course, your employer's putting more in, you've got to take that off that new cap as the caps occur. So yes, we can do it through our employer, and we'll be talking about a bit more on this, how all this all works, an example on salary sacrifice in a future session here. But if you don't have an employer, or you don't want to do it through your employer, then we can actually just fill out a form to claim the tax deduction. So we can put the money in ourselves. We can put the money in ourselves as a non-concessional, and then convert whatever we are allowed to into concessionals and get a tax deduction. So you might not even know how much you can do. So you might be just to put some money into a super fund. You sort of wait until the last pay period of the financial year. Have a look on your pay slip to see what your year to date is as far as employer contributions. Most pay slips will show you that. If you've still got a bit of space, well then yes, you can either make a contribution to bring you up to the level, or you could indeed, if you've already done some contributions, literally fill out this form, an NAT 711221 form from the ATO website, to literally convert whatever you've already put in up to the cap into concessional contributions. The form basically is a two-pager. I've just given you a little bit of a snapshot there of the bit that's most interesting. The form itself is actually called Notice of Intent to Claim or Vary Deduction for Personal Superannuation Contributions. What a mouthful. So I just usually give you the form number from the ATO website and an NAT 71121. If you Google those, you'll find the form. First page or so is literally just who you are, all your contact details, the name of your super fund and all the super fund details. But it's on the second page at the top here that's the important bit in section C. And we're basically just sort of saying, is this your, are you amending a previous thing, or is this a new application? And then it says what year. So if we're going to do it this year, it would be in the, the 23-24 financial year. So you put in there June 2024. And then you've got these two boxes. My personal contribution to this fund in the above financial year was. Now, so you might have done $100,000 as a non-concessional contribution. But out of that $100,000, we've got a bit of space for our concessionals to claim a tax deduction. Therefore, in point 13 there, the amount of these personal contributions I will be claiming as a tax deduction is whatever your cap space was. So you can indeed therefore target this thing. And of course, if you can afford to do it, not a bad sort of strategy to start thinking about, that if you're going to get a tax deduction for putting this money in, that's, it could be a nice incentive. Of course, the downside, any money you put into super, it's going to be locked up, it's going to be preserved until we can grab this money much, much later in life. But obviously, if you're getting close to retirement, we're not locking this money up for years, it could indeed make sense. Or if you really believe that you've got some spare cash, and just do a comparison of where else could you put that money to get the same benefits, but realising you are indeed locking the money up for the rest of your time until you can retire, which we'll talk about obviously in later sessions as well. Now, there is this quite a nice little additional thing that we can do with concessional contributions. Only came in 2018, and what it is, it's for anyone who really is trying to play catch up, literally, in the regard that you're getting older and you've got less than $500,000 in your scheme, and you decided that, yep, I couldn't afford to do it before, but gosh, now I can. So this could be someone who's got interrupted work patterns, or you've been working casual, now you've gone full, or your kids might have stopped going to private school and you've got a bit of extra cash. You might have paid your mortgage out and you've got a bit of extra cash now that you didn't have before. You can actually go back in time. Effectively, we're going back 5 years. So we can go back 5 years. It's a 5-year rolling period. And over that 5-year period, you can actually see what you did, whatever you didn't use, you can now use going forward. So you can go back 5 years, and if you had a $10,000 space from 5 years ago and another $10,000 space from 4 years ago, and so it goes on, you might indeed be able to put another $40,000 or $50,000 in and claim tax deductions. And of course, this is where you might want to talk to your accountant or talk to someone who understands this, to sort of ensure that you may still want to spread those things out to maximise tax deductions in any 1 year. You don't want to be sort of putting it too much in 1 year and then find out you don't have enough tax to deduct. So it'd be a case of sort of analysing it, finding out what you could put in, and then working out, is it a good idea to put it all in 1 year or spread it out over a couple of years or whatever. Remembering, of course, that the next year, what you could do from 5 years ago disappears. It's a rolling 5-year period. So as you tick over a new financial year, the one from 5 years ago disappears, and so it goes on. Now, you can indeed log into your MyGov account. And if you haven't got a MyGov account, I certainly strongly suggest you do. Get a MyGov account and link it to the ATO portal, and therefore you can log in see all your super accounts, what you've got, and there's a little tab there allowing you to see what your catch-up concessional contributions are. And so that gives you a bit of a good idea there. They think, okay, there they are, that's what I can do, and away you go. Again, you don't have to do any paperwork with this. It literally is you put the contribution, you claim the tax deduction, and it's all sorted out. See, the form you're filling out effectively goes, you fill it out, but you send it to your super fund. You send it to the super fund. You don't send it to the ATO. You send the form to the super fund. They will then earmark your contributions that you've made as concessional. And then what happens is the super fund, therefore they will deduct that 15% contributions tax if it hasn't already been deducted. And then they tell the ATO. And so the ATO will basically ensure that your super fund has got it all right. And then when you come to do your tax return, it automatically uploads to MyGov and you get the tax deduction. But effectively, as long as they get that form in, as I say, you don't have to get the form in before the financial year. You've got to get the form in before you do your tax return. So you've got to get the contributions in within the financial year to get them in, and then we can either claim or convert into concessionals with utilising the form. You only need one form. You might have made 15 contributions in the year. We only need one. If you're doing salary sacrifice, which we will talk about in another session here, which is a concessional contribution, you don't need the form because your employer is putting the contribution to super and they are telling the super fund that this is indeed a concessional contribution from your employer. If you are setting up regular payments through your employer, make sure they know what type of contribution you wish to make. Okay? If you tell your employer you want to put some money into super, I've seen it happen where employees, yep, we'll put the money into super for you, and they just do it as a non-concessional, where you were expecting them to do it as salary sacrifice, a pre-tax contribution, as a concessional contribution. So you need to tell them. Some employers will not let you do it. They don't have to let you do it. And of course, if they won't let you do it, then fill out the form. Do it yourself as a BPay. Some employers will send you off to a third-party organisation to do this salary sacrifice because they don't want to be deemed to giving you advice that salary sacrifice is a good idea. Now again, if you have to do that, there would be a fee for that third-party organisation. So yes, you could do it that way for simplicity, but if it's a case you want to avoid the fee, well, again, you could do your own BPay, fill out the form, and to avoid the fee. So it just depends on, how much you understand this, how much help you need. We're certainly here to help you understand how it works. We're not allowed to give you advice on salary sacrifice. We can't tell you, yep, do it. That's advice. We can tell you how it works, and we can tell you the benefits of it, but we're not allowed to tell you directly whether this is a good idea for you or not. But we'll certainly give you enough information for you to make sensible numbers to understand the ramifications of doing so. Okay, hopefully that was helpful. We'll certainly see you again, or hopefully we'll see you again on a future episode.